Alrighty, good morning. Let's do a quick audio check and then we're going to get jumping in, but I hope you had a good weekend. Hey, what's up, Terry? Good morning, Terry. All right, let me get a couple of notes up here. All right, so I'll paste these over here in the comment section and then I'll pin them later on. There we go. Good morning, Brian. All right, so audio seems good. Let's get jumping in, gang. We got a good 20 minutes or so. So next week to 2 weeks here. Let's see. And let's get those Bollinger Bands up. Alrighty, so next 1 to 2 weeks here, the major focus for me is going to be on this daily squeeze in the S&P 500 and whether or not the squeeze here can ultimately fire to the upside. So if we look at March, April over here, that was the last really good round of swing trading. NVIDIA, PayPal, Square, Google, Facebook, pretty much take your pick. You're going to get some good swing trading under your belt when the market is set up in a squeeze, potentially getting ready to fire to the upside. So with the squeeze here is a few key levels we do want to mark up. And as far as the squeeze finally getting going, one level I want to mark up here is the 21 period EMA. So we can go ahead and do that there. Pretty much basic stuff. If you're looking for the squeeze to ultimately fire towards the upside, at the very least, you want to hold support of the daily 21. If we keep losing the moving average here, there's just a better probability, not necessarily that we're going to roll over, but if we're going to see the squeeze fire to the upside, we at least want to hold daily structure. So the 21 EMA, that's a key level there for the SPY, and then the same thing for the Qs. Now the Qs have been a little bit sketch here. And they're going to continue to be a little bit sketch until we're finding some legit support back above the 21. So mark that level up as well. But from a bigger picture perspective, if we look at the weekly chart of the Qs, everything about this is still bullish. So I know tech has been a little bit sloppy over the last, call it month or so, but from a weekly charts perspective, all that really was, get rid of that. The last month or so, all this really was a pullback of the weekly 21. Just like that pullback, we're holding support just like we did over here. And granted, you don't get the turnaround back to the upside immediately, but as long as you do hold structure on the weekly chart, at some point, you got a decent chance, especially with a squeeze to the overall market, that technology can wake back up and make another move back towards the upside. So the weekly structure is still checking out for the Qs, and then the same thing here for the SPY. We didn't even close below the weekly 8 last week. So we got the little spike in volatility. Things did get a little bit sloppy, but as far as big picture structure, everything still looks really good here. So the question is, the daily squeeze with the SPY, the odds of this firing to the upside, if we can't hold above the 21, those odds decrease. But let's assume for conversation's sake, we hold structure, we hold up here at the 21, and that over the next week to 2 weeks, the daily squeeze does unfold. At that point, you're looking for a move to at least plus 2 ATR. That brings us towards 42.50, which would be a brand new high. So for conversation's sake, say the squeeze fires long, we get the move into 2.5 ATR. That's a lot of momentum for the overall market. And as goes the overall market, there's a lot of upside across the board. So the question is, where do we want to look to participate? Should we have the overall momentum for the market? So there's a few different places to look. You could look at the sectors that have been recent leaders. So while the tech sector and the semiconductor sector have been a little bit lackluster, it's the energy sector. It's been super strong as of late. There's the financial sector, which has been really strong as of late. You have IYT, the transportation sector. There is the industrial sector. So my general thought process is, that's where the leadership has been: financials, energy, transports, etc. If the overall market fires a squeeze to the upside, you probably see some continuation of that strength in the financials, in the energy, in the transports. The question for me is, though, in those different sectors there, where can I find my go-to setup, which is that clean daily squeeze? So if we go back to the financials, as solid as they've been, And I would expect a nice dip here. They probably continue to be solid. There's no daily squeeze. So they probably keep going higher, right? But there's not the structure I'm looking for. I don't really got that high probability setup. The same scoop here for energy. It's been a leader, probably continues to go higher if the overall market fires that squeeze, but there's not much for me to work with here as far as my go-to setup. So what I do like is the industrial sector. So we talked about this last week, talked about it in the Sunday video, but I like the timing here because the overall market has the daily squeeze. And again, for conversation's sake, if that squeeze can fire long, then whether it's an industrial stock, a financial stock, an energy stock, a tech stock, as the overall market is releasing all that energy to the upside, pretty much everything across the board has got a decent chance of seeing some of that momentum. But then take into consideration, let's just ignore the fact that SPY has a squeeze. The industrial sector has its own squeeze. So all on its own, it's got that structure I'm looking for. A good looking trend, you got the squeeze, and you got the stacked EMAs. And if you dive a little bit deeper and you look at a few of the stocks within the industrial sector, my two favorites are Caterpillar and Triple M, all on their own. Ignore the fact the industrials have a squeeze. Ignore the fact for now the SPY has a squeeze. All on their own, these have beautiful structure. We're all on their own. This is the kind of structure I'm looking for if I'm looking for that high probability move into 2.5 plus ATR. So what I do like so much about the industrial sector and Caterpillar is everything is coming together right now. All on its own, here's a high probability structure, then take into consideration part of a sector that has the same high probability structure, and then take into consideration the whole freaking market has the same structure. This is my favorite time to swing trade. Admittedly, things could roll over from here, but I'm thinking in terms of probabilities. So for Caterpillar, I don't think you can go wrong here. Beautiful structure. I think Triple M is a good looking structure as well. And I've been keeping an eye here on UMP, which is still pretty clean. I would have liked to see it back above the 21. You don't have stacked EMAs, but regardless, if the overall market goes higher and then the industrials fire their squeeze, UMP's probably going to go with it. But between the three of them there, I like the structure of Triple M and Caterpillar a little bit more. So for Caterpillar, give you all a quick peek here what I'm rocking with. June 11th expiration. So typically I would have gone with the monthly, but the spreads are a little bit whack there for the cat. So two different sets of spreads, got 242.5 by 237.5, and then 235 by 230. So the 230 strike credit spread, we need to pull up Caterpillar. But for the 230 strike put credit spread, or 235 rather, right? What the hell do I even have? 235. So for the 235 strike, going to need Caterpillar to simply hold above the 21 as we approach expiration. But I'm looking for that move, believe me. +2 to +3. So the 235 just requires Caterpillar kind of keeps itself together. And then the 242.5 short strike, which is in the money, well, that trade only works pretty much if Cat can make the move into 2 plus ATR. So that's what I'm working with there. No plans to add as of yet. But that's my favorite individual sector to try to get a little bit of this overall market momentum from the squeeze over there in the SPY. So you can take Cat, you can take Triple M, but then as far as technology goes, weekly chart I think looks great. The daily chart is still a little bit sketch, but you can see we're almost up about 1% this morning. So as sloppy as tech, and you can look at the semiconductors, as sloppy as these have been, they were already a bit oversold, hitting -3, -2 ATR. In a daily squeeze for the overall market over here in the SPY, definitely not a negative as far as seeing technology and the semiconductors rebound a little bit. So as far as structure goes, taking into consideration the SPY has the squeeze, if we can just get a couple solid closes here back above the 21, and then of course the SPY does start to follow through, I think you can see tech and semis kind of wake back up. and play along in the move to the upside. And all I would be looking for is pretty much a move back towards those previous highs, right around +2 ATR. So I think, be a little cautious with tech. Maybe you don't go too crazy here. But as far as the names within the tech sector that look pretty solid, let's start with what doesn't look solid, actually. Y'all know I love Amazon. If I didn't know there was a squeeze in the SPY, and I didn't know the Qs held up on a weekly chart, and maybe they're coming back to life here. If we didn't know those things, and we're just looking at the chart of Amazon objectively here, no daily squeeze. It's under the 21. There's no positively stacked moving averages. That's not the structure of a chart that suggests to me, putting everything else aside, that it's got a huge probability here of making a move higher. Now, of course, if the market fires long, the Qs wake back up, Amazon's going to go back to the upside, but it's not the kind of structure I really am digging here. There's Microsoft. No squeeze, no stacked DMAs, no trade. Apple. Now, they all go higher. Apple, Microsoft, Facebook, Google, they're all going higher, but it's all about the structure. And Apple doesn't look that good either. No stacked EMAs, no squeeze. So I think Apple, Amazon, and Microsoft looking a little bit duddish here. But what does have the structure I'm looking for is Google and Facebook. So Google still looks rock solid. Here you have a daily squeeze. You also have the stacked DMAs. Though every tech stock in the basket should make a solid move higher if the overall market does, all on its own, this is a high probability setup. So for Google, I got some skin in the game over there. And I got to think about whether or not I want to add to it. But for Googs, the big Goog, looks like we're going to gap up a little bit this morning. But I got June 18th expiration. So I got the monthlies on this one. Out the money, put credit spread 2290 by 2270. So it's not a huge position, that being a relative term, but it is a bigger position of mine right now. And with everything kind of setting up here in the market, as long as we can hold structure above -1, well, ultimately, I'm going to look for that squeeze to fire long for a move into about 2400. So I love the structure there to Google. And then for Facebook, you got the same good-looking structure. Stacked EMAs, good-looking squeeze. And last week, it held up really well. So I think for Facebook, they're basically mirror images. So keep that in mind. You don't need to take a 10% position on Google and then add another 10% to Facebook. They're both tech stocks. They're both squeezes. They're both going to go higher or they're both going to go lower together. Basically the same trade. But for Facebook, that looks pretty damn good as well. So a move into about 2.5 ATR. If everything unfolds to the indexes, I don't think you're too crazy there. But hopefully that makes sense as far as, all right, you're saying you think technology might have a chance here of making a move back towards the upside. So why don't you like Amazon? Why don't you like Apple? We're trying to stack probabilities. So what I love so much about Google, for example, is, again, ignore the fact that the Qs might be putting in, a nice reversal here. Ignore the fact the S&P 500 has a squeeze. Without those elements, Google already looks rock solid. Just like over here, before the SPY was looking good and before the Qs were looking good, Google was looking awesome. That's the kind of structure you're looking for. Google finally explodes here and makes that pretty quick. Shit, it happened in 2 or 3 days. Makes the move into +3 ATR as soon as the market finally got behind it. That's where you're adding probabilities. All on its own, that's the kind of structure of a chart that's just dying to release some energy and make a nice move to the upside. I want to focus on that. And then we're stacking probabilities by waiting for the timing component with a squeeze in the indexes. And then the timing component of the Qs when we're getting spanked here, potentially getting back on their own 2 feet. So my good friends, hopefully that all makes sense. Another thing to do keep an eye on, though, is going to be this little pesky volatility index. So if there's anything that can interrupt a good-looking daily squeeze in the market, it's these spikes here in volatility. So for the last 2 weeks, we've seen the same thing unfold. Tuesday into Wednesday, big spike in VIX. So the market rolls over a bit, or rollover is a bit of an aggressive term. Market drops, VIX comes right back down to the 21, market goes right back to the upside. And then again last week, right on Wednesday, another spike, another drop, all that back and forth. So the major thing we need here from volatility, we don't necessarily need it to keep going lower, but no more of that crap. Just kind of stay near the 21, chill out just a little bit. And if then VIX can kind of stay a day there, then I think we got a good week or 2 weeks here to potentially see this unfold to the upside. So that's the focus list there, my friends. Recent signs of leadership have been in energy, financials, transport, industrials. They all probably keep going higher if the SPY goes higher, obviously. But I like the industrials because of the squeeze. Inside the industrials, I'm liking me some CAT. So I got the position there. UMP is still pretty good. I think CAT and Triple M look a little bit better. And then as far as trying to catch any potential rebound here for the Qs, you got to do so with a high probability setup. They're all going to make a nice rebound. I don't like that Amazon chart. I don't like that Microsoft chart. I don't like that Apple chart. But I do like Facebook there. And I do like me some Google. Those are the couple things I'm focusing on headed into this week. I do got a couple of short positions in the back pocket, which is the market's moving higher here. You know, these shorts go against you. But I'm going to keep on holding on to a couple of shorts. Keep a couple in the back pocket just in case we get a rainy day. But that's a focus list, my friends. Let me jump into questions here. So Mr. Blue Chip for Tesla. And keep in mind, I love trading Tesla to the upside, which is obviously, it's been the theme over the last couple of years. But for me, it's all about structure, not the stock, not the the company, the CEO. It's just a structure of the chart. So if you look at Tesla from a weekly perspective here, this to me actually looks a little bit bearish. The weekly chart doesn't have positively stacked moving averages. We're in a weekly squeeze under the weekly 21 with a negative histogram. So if the market goes crazy from here, Tesla probably goes right back to the upside. But based on the structure of the weekly squeeze, I actually do think, especially if there's a potential here into the summer, the market puts in a short-term top. Personally, I'm actually looking for Tesla here to fire this weekly squeeze to the downside, which should bring us to about 445, 450, which is minus 2 ATR to the downside. So the weekly chart, I think, is pretty jacked up. And then the daily chart here, it just has components of the kind of thing I like to short. No positively stacked moving averages, red 10x bars. And that was a good short a few weeks ago. Took the short position here, sold the calls, I think, at, I forget where we sold them, but we sold the call credit spread at 695. That's what it was. Short near the 21, take profits into the minus 2, minus 3 ATR flush. Basically the opposite of what I'm looking to do with Caterpillar. Because of Caterpillar's structure, get long at the 21, take profits at plus 2 to plus 3. So it was only a few weeks ago, we were going long Tesla in the options room because of that bullish structure. It had stacked EMAs. It held weekly support. It was above the 21. Histogram's positive. Get long here. Take profits there. Because of the structure now, I'm more so looking to play it to the downside. But I need a bigger bounce here. We're basically just kind of clinging to minus 2. Going to need a little bit more of a bounce. But keep in mind, as goes the market, goes the stocks there. So daily squeeze of the S&P 500, it's definitely not bearish for Tesla if it fires to the upside. So keep that in mind as well. But listen, friends, I got to hop off the mic here. Got to hand over the platform to my simpler teammates. So hopefully I've given you a few things to focus on. We'll be back on Wednesday, do another good 20, 25 minutes of prep. And then for those of you in the options room, I'll see you in about an hour. But be safe, focus on the basics, focus on those key levels of support, and then focus on, I think, the Caterpillars, the Triple M's, the Facebooks, the Googles. And then it's just a big question of whether or not the squeeze here gets squozen. So trade safe, be safe. I'll talk to you soon. Always appreciate you tuning in.